Rask top wherever I go. So I'm pretty consistent. If that's fashionable, then let's do it. I'll take it. We've got an extra special show tonight because I'll be joined by Cameron Gleeson in just a moment from Betashares ETFs, who you may have seen around. Cameron does a lot of educational and insightful things on podcasts, on different mediums throughout the internet, and I'm sure in person too. So I can see there's a lot of conversation about disclaimers. Martin, Rob, who's in the chat already, is saying that he's so excited for the disclaimer slide. I know that every week everyone writes in and they just say, wow, amazing disclaimer this week, guys. Like, I couldn't believe how good that general advice disclaimer was. So why don't we hop to it? I'll share my screen with you right now. Here we've got our joke of the week. Now, this one wasn't chosen by me. This was chosen by Rask's new marketing manager, and she took this from Dad Jokes, or Dad Says Jokes on Twitter, which goes something along the lines of, when my father dies, he wants his ashes pressed into a record. It was his vinyl request. So that's the joke for this week. And so far, the only piece of feedback that we've had on this joke is that it wasn't very good. But that's a dad joke for you. Like, dad jokes aren't meant to be good. I think they're meant to be kind of cringeworthy in a PC way, of course. But that's the joke for this week. Now, on to I think the thing that everyone has rocked up for, which is the general advice disclaimer. Just a reminder that any of the information that we deliver tonight is strictly limited to general financial advice only. It is not personalized financial advice. Even if I or Cameron take one of your questions or comments that you put in the chat and we respond to it, we will be responding in a general way because we do not know your personal circumstances. It's also important to understand that the views expressed in this live stream are solely those of myself or guests that appear on the show and do not necessarily reflect the views or opinions of Selfwealth. It's just a wonderful disclaimer. I think everyone can agree that the best slide of the night. But anyway, we move on. I can see I got a 4 from Paul. I think that was for my joke. However, if that's for disclaimer, I think it's you've underappreciated how high quality that disclaimer was there, Paul. So this slide here, you can see that we've evolved the series, and this week we're talking about the 10 common mistakes that ETF investors make. Last week, in the first installment, we talked about what basically everyone needs to know about ETFs just to get off, I guess, first base, and just to try and think about, how do I use ETFs generally? Why would I use them? How do they function? You might remember we talked about actually what happens behind the scenes. And I think we're going to talk a bit about that tonight in the 10 common mistakes that people make. So Cameron's come back with a great list of 10. I can see, Paul, you've just updated with a 10 out of 10 for the disclaimer, which, although you did maybe misspell that, you said disclaimer, meaning maybe that it's a bit lame, but Rob's given me an 11 out of 10. So he definitely passes this test. So without further ado, I might bring Cameron into the conversation. So Cameron is a senior investment strategist at Betashares ETFs. Cameron has appeared on the Australian Investors podcast recently talking about a bubble in ETFs. We answered some questions, and Cameron, welcome to the show, first and foremost.
Thank you, Owen. Great to be here. And I will say that that's probably the first disclaimer slide I've seen with a photo in it. So I enjoyed that, at least, and it was better than the dad joke anyway.
Well, thanks, mate. I do need to get better at my jokes, that's for sure. But my disclaimer game is getting quite good nowadays. But one of the things that happened recently was we sat down and we talked about an ETF bubble and this idea of all these famous investors saying that maybe we're in a bubble. I haven't actually told you this until now. That was actually one of the most popular episodes we've aired this year. And so I would encourage anyone who thinks that there may be a bubble in ETFs and how they can think about it to go back and check that out. But I'm hoping we can do a bit of a repeat of that tonight, mate. So tough act to follow. But why don't we jump straight into it? We've got a list of 10 mistakes ETF investors make. And we can start maybe just with the first one, which is quite, I would say, high level, but important, which is a lot of people make the mistake of just collecting the favorite ETFs with no overarching strategy. I had one person write into me recently that had 30 ETFs. So I feel like that's too many. Can you just expound on this a little bit for us, mate?
Could be. Obviously, depends on personal circumstances. So this is really, I guess, a trap that a lot of people fall into, even outside of thinking about ETFs, is really, building an investment portfolio without that overarching plan. And I can think of, my journey in financial markets, and when I started working in markets, getting some, hot tips from friends and starting to buy individual stocks, probably 20 years ago now. And I think I had a portfolio of stocks like, Transurban, Brambles. I had Babcock and Brown Infrastructure, Fortescue Metals, but there was no rhyme or reason other than I thought these stocks sounded really good and that they might well go up in value. And I think that's sometimes a trap that people fall into. There is a lot of narratives that are produced by people that work in the funds management industry, and the ETF space is no different to that. And it can be enticing. You can get caught up in narratives and simply, pick funds or ETFs because they sound attractive, because the story sounds good. And when you start to do that and accumulate funds, you might reach a position 2 years down the track when you look at your portfolio and you can't actually remember why you held half those funds in the first place. So I think, the first thing that you need to do when you're looking to build a portfolio of whether it be ETFs, funds, or individual stocks is sort of take that top-down approach and have an asset allocation in mind before you even start thinking about individual ETFs. How much do I want to have, for example, in Australian equities? How much do I want to have in bonds? How much do I want to have in global equities and other asset classes? That's really your sort of framework for how you start to think about building a portfolio before you start thinking about individual ETFs.
I find that this is a part where obviously financial advisors add so much value because they sit down with you and they take that into account. They have the wisdom typically of years under their belt. But we spoke about this in the first installment of this mini series where we talked about, I guess, even just an understanding of different asset classes can help people be informed about, I guess, the trade-off between risk and reward. And I think that's kind of a lead into the next point, the next mistake, which is having vague investment goals. So when people maybe don't have that clear strategy, they don't even start at like, well, why am I doing this in the first place, and working backwards.
Yeah, that's it. Spot on. I mean, that first mistake, it does somewhat depend on, your level of understanding of investments and how they work. But before you even get there, you need to have an intrinsic understanding of what you're trying to achieve. What are your goals? And I can think about this from my own. Again, I'll refer to my own sort of journey. And there was maybe about 4 or 5 years ago, I bought a house, and before that, my investment profile was maybe shorter than it is today. Buying a property, is a big deal, and it's a massive financial goal. Now, if I was looking to buy a house in the next year or two, my investment time horizon is very different than if I'm saving for my retirement. So just a consideration of what you're trying to achieve and being quite concrete with that. And then also where you might use a financial advisor is trying to get a feel for your level of risk tolerance to understand what combinations of asset classes will work best to deliver to really what you're trying to do is maximize the amount of returns you may expect to get for the given level of risk tolerance. So those two things come hand in hand, but they're really the bedrocks to any form of investing.
I find that this is a great thing because it's kind of like one of those, it seems like a dark art, or at least for a lot of people, it's like almost like the pseudoscience of investing. It's like there aren't numbers to put around goal setting. And what I think about is, I think if we use a different word in finance, if we instead of saying like, what is your financial goal? Maybe what is your financial motivation? Like, what are you motivated for in life? What are you motivated to achieve in the future? I find that kind of turn of phrase actually leads to people to try and break it down. Well, what's actually motivating me to do this? And what's actually like, why am I taking risk with some of the capital, which you mentioned is like the given level of risk, like what return do I expect, and optimizing the portfolio for that.
I think you're spot on there, really. I mean, when we often do on a superficial level talk about goals we're looking to achieve, but there's a level of psychology to being a financial advisor. What you're really trying to get to is, what is the underlying driver for that? What's the motivation? As you say, that's, if you can get to that point and have an honest conversation with yourself, then hopefully you'll end up, in a better spot to understand what you need to build as an investment strategy.
Yeah. And I think we often say, like, on our podcast, is actually just even having one goal is enough. Just having one reason gets you started, and it keeps you kind of like, it's like that North Star that just guides you. You might take a different path at night, but you eventually end up going in the right direction. And I think that's where that first kind of beacon that you set is really important. But mate, in terms of logistics, so a lot of people, when they think about ETF investing, we've got that first one, which is collecting, your favorite ETFs. There's like a hot theme, or maybe someone told you about this at a barbecue or whatever. A lot of people then end up with significant overlap in their ETFs, and they don't check the ETFs. They don't even check necessarily what's inside. They just kind of go by the name. So the third mistake, which you've identified, is people not looking under the hood. So can you explain what you mean by that, and how people can think about it?
Yeah. So one of the great things about ETFs is that they typically have more transparency than, for example, actively managed funds. There are actively managed ETFs, but even those have to disclose their holdings on at least a 3-monthly basis. However, most ETFs are, they track some form of index, and will in fact publish the methodology of that index, and will publish the holdings and the sector breakdown, usually on a daily basis. Now, this is, really useful to you as an investor. And we're scrolling through the Betashares website here. You can see top 10 holdings. You actually click and see the full list of holdings. As an investor, to get an appreciation for what's in that portfolio, because one of the great challenges with, for example, funds management, active managers, is that you may not necessarily be getting what you think you're getting. The same can be said for ETFs. Is if all you read is the fund name and the ticker code, that might lead you to think you're getting an exposure which isn't quite what is actually in the portfolio. So I would always encourage people to, read beyond the fund name, read beyond the ticker code, get an understanding to how that portfolio is constructed, and have a look. Look, maybe I've got exposure to US equities, and that might use a particular strategy that leads to, high allocation to IT companies in America. Do I have that elsewhere in my portfolio? Are there overlaps? It's all part of that piece of building that robust portfolio. And given the transparency available in ETFs, you can actually do that where you can't necessarily do that with other investments. So you should look to take advantage of that.
I really like this idea. And one thing that I see popping up a lot with people who try and educate around this is we express it as percentage, like the percentage of the portfolio is invested in this. But it's that old thing of, imagine someone, put $100 note in front of you on the table, and you had to cut that up. Well, in the case of NDQ, and I'll bring this up again really quick, which is the NASDAQ 100 ETF, $12.50 of that $100 is going to go just into Microsoft as of today's date. And then you're going to get $12.20 of Apple. And I think if you think about it, like how much of your $100 is going in a certain direction, it just gives you a proper tangible feel of, well, actually, I might be thinking I'm just getting $100 of ticker symbol NDQ, but no, actually, once you drill into it, you pop the hood, what are you actually getting for your money? I think that's kind of the key insight. And it's a mistake that a lot of investors make, but I think many investors are now waking up to this, Cameron. I think we've gone, as an industry, from the last 5 years, we've gone from like, what is an ETF, to, okay, I'm trying to build a portfolio. Okay, now what do I want? I want to know what's inside it, and how do I break it apart?
Mm-hmm. I mean, the lucky thing for Australians is that, we and I'll say this and it'll sound silly, but, we've only got, 200 ETFs in Australia versus the US, where they actually have thousands. So, I pity someone who wants to try and scroll through and understand every ETF in the United States. But I think, you should also feel, able, and you should, contact an ETF provider if you don't understand what's going on or how it works. It's incumbent on them to explain how their fund works. Ask them, is this going to provide exposure to ABC? How is this going to look compared to my existing? If I've got, for example, NDQ, if I was to add another fund, where are the overlaps there? What are the correlations? How closely do those funds move together? And if they're, they should be willing to support their products and provide education in this front.
That's a really good point. There was a comment from Bright But Never Burned that I read a statement that there are more indices than equities in a lot of markets, which is like having more football teams than players, which is quite a good one. And indeed there are, right? There are a lot of indices like the ETFs can track. But I'd say that maybe it's important for people to understand what an index is, and they may not need to be necessarily an ETF tracking that, or it's just about having the option, right, for an ETF to track something if they want to.
Yeah. I mean, yeah, you're right. There are many more indices than there are ETFs. Part of that is that indices will take slightly different flavors. Like you might have, for example, a FTSE 100 ETF, which is in Australian dollars versus UK dollars versus euros. So because of the ability to effectively generate multiple indices out of a single underlying basket of stocks, you do get that long list of indices available globally.
You mentioned in the fourth mistake that people make is missing out on the benefits of compounding. I'm curious why you think this is a mistake that people make. So like obviously people missing out on the benefits of wealth creation, but can you explain this one insofar like as how it relates to ETFs?
Yeah. So, look, it probably relates to what I think I put down as the next mistake too. But we've seen over time that compounding really is the way that you generate wealth over a period. It's being in the market over a long period of time. We know that most developed economies have shown strong economic growth over a long period of time, and that's really created the upward impetus on basically equity valuations. Japan obviously went through a long period of drawdown, and their equity market, in fact, suffered for a long period of time since the late 80s. But most other global markets have over time, gradually risen. There's bumps and there's movements along the way, but I guess that having removing some of the emotion of the investing process, continuing to invest, despite whether or not you think this is the right or the wrong time, being almost mechanical about it, chipping away every month, part of your paycheck, putting that into the market, and to talk about the next mistake, an underappreciation of fees. So one of the great things about ETFs is that they typically are lower cost. Now, if you're comparing a high cost investment product to a low cost investment product, that compounding effect, the difference in fees, doesn't necessarily appear that significant on a single year. But after 10, 15, 20 years, which is how long realistically you'll be investing in, that compounding of a lower fee base versus a higher fee base makes a significant difference. And obviously, ASIC require that product providers actually include these sorts of disclaimers in their PDSs these days. And for that very reason, it's important to think about that. So using a product that has a lower cost base to generate returns through exposure to markets, we think is the right way to think about investing.
I like that. It is true, right, that the small differences make a big impact. You're right. Like for anyone that hasn't read a PDS and might be listening right now or watching, you think like it's maybe not that big of a deal, but if you go into the PDS, it actually expresses in dollar terms and in percentage terms what the impact will be, like a 1% difference in fees. And it's true that the higher the fees, the more it takes away for you. But I would say, like, I think we've also come to a part in our industry now where, like, sure, we see fees dropping, like Betashares dropped the A200 fee, if I'm not mistaken. And that's great for investors. But there's also a trade-off that some people will make around fees, right? Like that in some instances, they're okay paying a little bit more for a certain type of exposure if it's the right type of exposure for them. Because let's be honest, like even a high fee in the ETF land is still very low, or typically very low compared to other investment products.
Yeah. I mean, that's right. I mean, I think Yeah, so one side of things is obviously is fees, and then the other is performance. And so we take that A200 example, which is our Australia 200 ETF, which is now 4 basis points per annum. So that's 0.04%. So it's obviously a very low level of fee, the lowest Australian equity broad market ETF available. The other side of thinking about compounding is, are you generating outperformance? So can I beat the market? And obviously, if you could consistently generate outperformance over time, you'll benefit from compounding. But one thing that the data has actually shown is that when we look at active managers, on average, over any sort of time frame, typically active managers on average tend to underperform. There will be some managers that outperform, but typically their outperformance is somewhat transient. And when you have fees always compounding, always detracting from your investment, whereas the potential for outperformance being mean reverting or sometimes contributing, sometimes taking away, that's where something which is low cost, which is giving you, market beta in a lot of cases, that compounding effect is really strong. Unlike maybe an active manager that sometimes gives you outperformance, other times draws down, plus that high fee load, that compounding effect can really hurt them. So probably just to differentiate between the ETF products and how maybe traditional active managers who seek to generate alpha, that the differences that can sometimes play out in compounding across those two investment types.
Yeah, it's something that people do tend to underestimate, is that if you have a higher fee on your investment, so an ETF or a managed fund or whatever it may be, when your investment falls, the percentage can actually be really meaningful. And you've got to make up ground as well, which means more outperformance, right? So it's a really important point that you touch on there. And actually, I do want to just maybe if I just circle back, and I'll just bring the slides up again before we get to point number 6, which is like the benefits of compounding. I think a lot of people that might watch this series, Cameron, probably are new to ETFs, and the benefits of compounding, I think, like, just should be double clicked on, in that we're not saying that you need to invest everything at any one time or anything like that. But what we're just realistically saying that is, if you keep your money, say, in savings as a different type of investment equities, historically, not being exposed to the stock market has proven to be a poor choice. You called out Japan as one maybe exception to that, where the Japanese stock market hasn't done that well. But for the most part around the world, long-term investing in the stock market does work, and an ETF provides a vehicle to do that, I would say, in a relatively simple and convenient way. And so that's where you get you may not get, the super high returns, which leads into the next point you've got here. You may not get the super high returns one year that someone else is promising, but maybe never delivers. You're going to get a consistent market average if you go with an index ETF. So number 6, Cameron, is letting your emotions drive your decisions and performance chasing. So this is a mistake that I see all the time. Do you want to just touch on this quickly?
Yeah, look, there's so many examples you could point to within sort of any investment lens, but even if you look at US households as a group and their investment in equity markets, just prior to the GFC 2007, we're almost at sort of record highs. And then as we saw that GFC unravel, and which we bottomed out in March 2009, they reached a low in March 2009. As people obviously became nervous, they started deleveraging, selling out of their equity portfolios with the volatility and blood on the streets that we saw back then. And that just talks to that investor psychology piece. It's obviously very hard to remain unemotional, given the potential impacts when you can see the value of your portfolio, your future wealth and lifestyle changing. And it's important to be sort of disciplined about this. Another element to this is that I think especially if we work in markets, we can often have a thesis for how we expect the next 6 months, 12 months, 2 years to play out. It's important to also sort of be humble, to appreciate that the market can make you look pretty silly, and not put all your eggs in one basket. So when we sort of talk about, for example, I think that maybe equities look quite expensive right now, that valuations look stretched, there's risk of a recession, that might cause me to tilt my portfolio, perhaps sell down some of my equities and invest in defensives. But I don't think it's a wise idea to completely sell out of my assets. I might, for example, look to underweight equities by 5%. But for example, even if I had really high conviction that was on the horizon, selling out of 100% of my equities, you can end up missing out on a lot of upside. And an example of that was subsequent to COVID, when, look, frankly, it kind of felt like the world was ending. We saw very strong performance out of equities in April 2020 and through the May and June. So never having, I guess, enough confidence in your own ability to predict the future, sticking to a system, and not getting too caught up in that shiny thing or the thing that's performed well, I think stands you in good stead to continue building wealth and compounding over time.
We talk about that a lot as industries, even as an industry, even in the finance industry. For those of you that don't know, they give out awards for funds, and they're typically based on like that year. So it'll be like the top fund that year. When if you think about what Cameron and I are trying to allude to here is like long-term investing, which is what ETFs were designed for, is not measured necessarily in 1 year. Like, we do measure the returns, don't get me wrong, but we typically are taking a much longer term horizon to get the full benefit of compounding. And that's where a lot of investors, I think, go wrong with this point and in the previous point, Cameron, is they kind of target the highest return, not thinking about the risk or past performance, and they get stuck in that thought of like, well, maybe last year's performer is going to be a better performer this year. But we also see in active funds, there are some studies and some research that seems to allude to the fact that people in actively managed funds also tend to do worse than the returns of the fund itself. And you ask yourself, well, why? It's because people chase the returns even within the one fund that they're investing in. They'll invest more at the top and less at the bottom. And it's just that behavioral element.
It's true, isn't it? And it's hard to resist that. I think some I guess some of the framing to sort of avoid that performance chasing is making sure that you're paying attention to the risk. So often that shiny thing that's performed very well might in fact also be quite volatile, might be quite risky, might be quite skewed to a particular area of markets that has gone through a bubble-like cycle. So look at that risk, look at how it blends in with your overall portfolio, and that maybe keeps you more level-headed when you're trying to assess something, rather than looking at that that shiny performance figure or the award they've just won for that shiny performance figure.
Absolutely. Like I would encourage anyone listening to this to look at many years of returns if it's available, rather than just a single year, and look at it. Put an ETF right beside another ETF that might be similar but different, and see what you come up with. So there are some good questions that have come through. We might keep a couple of them once we get to the end of this tandem. Maybe we can put a couple of questions to Cameron then, including Jeremy. I think that one was good from you, even though we did cover it last week about equal weight ETFs and the difference between those and other ones. We'll cover that in a minute. But number 7, Cameron, was overcomplicating your portfolio with too many small ETF holdings. So we did talk about this before in the first one, but I think we find this a lot. A lot of people kind of experiment. Maybe experiment's okay, but what does that kind of leave? Just leave like a graveyard of ETFs in your portfolio.
That's right, and it's like it creates a burden of due diligence for you to continually monitor these funds when if they're perhaps a 1 or 2% holding in your portfolio, they're not really going to impact your overall investment outcome. So I often advocate for slightly higher holding weights than that, because there is that you don't want to forget the fact that you do need to watch your portfolio, and that some funds require a bit more due diligence. So creating that extra work, which frankly you might shirk, leads you into a potentially risky situation.
Yeah. I couldn't agree more. So at number 8, we've got, this is the one that's probably the one that we talked about a few weeks ago, Cameron, which is people misunderstanding what we mean by in ETFs liquidity. Like if people log into Selfwealth tonight or even tomorrow during the day and they want to buy or sell some ETFs, there's a whole bunch of kind of ideas, I'll say, out there about how ETFs should be traded, how you can study whether it's liquid or not. Last week, just as context, mate, we talked about how, like in the underlying market, ETFs are created by authorized participants and market makers and that type of thing. It was a bit technical, actually, but it was good for the show. So can you maybe explain that and how people should be thinking about this? Because I think this does relate to that bubble idea.
Yeah. So I think probably the first thing that people do when they're looking to buy a stock is that, that they'll go onto their brokerage account and they'll look and see, how much that stock's traded, how, the bid-ask spread and all those sorts of things. And, that's an accurate representation for an individual stock for how liquid it is, how easy it is to buy and sell, what sort of, buy-sell spread that you might have to pay. ETFs are a little bit different in that that's firstly what I call the first level of liquidity is what's being traded on market and often by, other investors, mums and dads who want to buy or sell. However, there is deeper pools of liquidity than that in the ETF landscape. We have also market makers who are, institutions who are essentially trying to offer bid and ask to create a market and ideally have other investors cross that spread so that they can generate a profit. But with an ETF, you'll typically have multiple market makers competing against each other. And so, that arbitrage, if you like, from the single market makers bid down, it creates quite an efficient process and means you tend to see quite tight spreads. But in either case, the amount that's traded on market isn't a good representation of the underlying liquidity. To give an example, A200, that Australia 200 ETF, it's an incredibly liquid fund, trades at very tight bid-ask spreads, around about 4 basis points, sometimes 3 basis points. So very tight spreads. If you were to try and assess the amount traded of the ETF on market, you might say that you could that ETF, you could easily trade a couple of $1 million in that ETF. But what really matters is the underlying basket of stocks within that ETF. And for that ETF, the actual traded volume that the market could withstand is around about $600 million worth. And that's because what really matters is how liquid are the underlying stocks within the basket, which makes up the ETF. Because that's what those market makers are able to trade and deliver to us as an ETF provider in order to create new units. So there's a few layers to ETF liquidity, but looking at historical trading volumes is not the best way to think about liquidity. A couple of key points, especially if you're maybe uncertain or newer to trading ETFs, there are a couple of play it safe rules. One would be the use of limit orders versus market orders. Now, and also I'd say also the time of day in which you trade. So as I mentioned, there are market makers who basically create a market in ETFs on the ASX. And there's always one designated market maker. They have requirements to be on screen to create spreads within a certain bandwidth almost the entire day, but that doesn't include the opening auction and the closing auction. And so if you're an investor and you use a market order and the market maker isn't there in the market at closing auction, then it's possible that you may well, if you were to buy, go through a number of levels and get really, poor execution or pay too much for your ETF units. By using a limit order at any time, you can ensure that you're in control of the price you're executing. And look, if there isn't enough, units on the best ask or bid at the time, then it's likely that market maker, if you've effectively sold or bought to that market maker, they'll add additional units, onto the best bid and offer, so you'll be able to trade again. But limit orders are, I guess a safer way to trade ETFs if you're not certain what you're doing. If you're across ETFs and you're very comfortable, then that's fine. Use whatever order type you like. But using limit orders can be, give you a margin of safety if you're not sure what you're doing. And best to avoid just that opening auction, maybe the start of the day. So between, say, 10:30 and 3:30 might be the best time of day to trade ETFs in terms of ensuring that you're going to get, really efficient execution.
Yeah. So that's a really good point. I'm so glad you took the time to explain the two different layers of liquidity for folks. So just to recap and just to summarize, because I think this is a really key point for folks, a lot of people will hear out there that you shouldn't trade at certain times. And I was asked this question last week about market orders versus limit orders. And so just to summarize what you're saying is if you trade with a limit order, you're basically setting the price that you're willing to pay for that ETF unit. And that's your order. Like legally, that's where you're setting your price at. But if you do a market order in most brokerage accounts, it could be fluctuate significantly at the beginning or the end of the days when the market makers are still spinning up or closing down. Is there any difference, would you say, between whether the ETFs are investing in Australian shares or international shares? Like, does that really matter?
Not specifically. Generally speaking, you'll see pretty good coverage across most of our, Australian, share funds. That they're all quite liquid. And you'll typically see, plenty of participation in the closing auction or an opening auction. But I think it's just worth, sort of keeping that in mind, just in case. So if you think about what these market makers do, I mean, especially at the beginning of the day, they're turning on all their systems. They're making markets across, maybe 100 ETFs. And, they need to make sure everything's working properly before they're really able to turn everything on. So just avoiding that time period, because if they're not in market, then you face the risk of that, basically hitting a bid or ask far away from the NAV or the true value of the ETF.
Yep.
I will say though, look, it's in our interest to make sure that everyone has a really good experience in terms of buying and selling ETFs. Typically, they trade at quite efficient bid-ask spreads versus other forms of investing. And so any ETF provider will be happy to talk to you. If you pick up the phone and call them and go, look, I'm thinking about trading, NDQ or, A200 or, any Betashares fund. If I trade now, is the price, does it look fair? That ETF provider will happily provide you feedback as to whether or not they think that looks like a reasonable price.
Okay, that's great. It's good to know. Once again, folks, just reach out to the people that make these products, right? Make it available to you. So number 9, second from last, and this is more of a quote, which is a mistake. Why has my NDQ ETF only gone up 1% when the NASDAQ 100 index was up 2% overnight? So people are thinking, why are these two numbers different, Cameron? I thought I was investing in the NASDAQ 100.
Yeah, so we receive client calls all the time. We have a team of people who take these calls, and this is probably one of the most common questions we get. When we think about ETFs, and let's just say if I'm trading an exchange traded fund over equities that trade in, for example, the US, and our hours are almost completely different to the US. In my head, it kind of makes sense that whatever happened there, like essentially yesterday, should be what the change in price in my ETF is here today. And so we'll see that where maybe the NASDAQ appreciated 2% on the day before, and then the ETF in Australia doesn't rise by that much. Why is that the case? Well, the reason for that is that the price that you pay for the NASDAQ ETF isn't just a reflection of the closing price in the US yesterday. There is a lot that actually happens between the US close and when you are trading in Australian time. There can be companies that will announce after close. There can be, geopolitical events. There can be, all sorts of announcements. And when ETFs are priced, they're usually priced based off some proxy of value. And for, the NASDAQ, there are futures that trade overnight. So, market makers, and also when we're valuing the ETF, we'll value that ETF based off that live price, which will be perhaps a futures price that's trading when US markets aren't actually open. So the price that you get is actually really a reflection as to, well, what's the best representation of value at 2 a.m. New York time. And so the movement I see from when I bought at 2 a.m. New York time to, the close of business, US time the night after, doesn't necessarily reflect the close-to-close price in the US, if that makes any sense.
Yeah, no, it does. And I was just looking on the website here. There is something that ETF providers publish. It's called the INAV. Are you able just to really quickly just tuck this in on what that actually stands for?
Yeah, so the INAV is produced. It's not produced for every single ETF, but the requirement there is to produce INAVs for actively managed ETFs, because actively managed ETFs, there's not actually a requirement to publish the whole basket. So it's to ensure that people have a transparent representation as to what the value of that ETF is at any time. We do also produce them for our Australian ETFs. But we don't necessarily produce them for the passive global ETFs, because that basket of stocks is fully transparent. So market participants can actually, in fact, calculate the value of that at any time. But what you can do is you can actually go to, for example, the ASX website, and they have a page where you can download a report for ASX investment products, which includes exchange traded funds. And you can see what the in any month, what the buy sell spread of that ETF was on average across that month. You can do it, look at every month across, for the last sort of 5 years. And when you're looking at this on market, generally speaking, the buy sell spread will be either side of that INAV, or the value at the time. You should be looking to try and get execution around about exactly there. So you can click there, you can drill down across all the products issued, all available on the ASX, and look at what the average buy sell spread is of that particular fund. In very small font there, but there it is. You know it well, Owen.
Yeah, I love this report, and it's what I've been studying for years, to be honest. So you get to see here the buy sell spread, 0.03, and that's on A200, right? So that's what I would deem as a very tight buy sell spread. So this, just to confirm what people need to know about this is basically when you go in or out of an ETF or a fund, how efficient is it? So you want that number to be as small as possible. And it used to be the case, or it still is the case, that it's 0.3%, so 10 times that amount for some managed funds and some actively managed funds. So that gives you a sense of how efficient ETFs are. In this case, they're 10 times more efficient just to get in and out of the position. That's thanks to all the things that you were saying about market makers. But mate, we could probably talk all night. I do want to get to this last one, which is lucky number 10, which is the boring stuff that people tend to forget about when they're ETF investors or share investors, like direct share investors. Everyone seems to forget these two things. What are they, and why do they count?
Look, I mean, that they matter, right? Tax is an important part of your overall investment returns. You don't necessarily see it in a performance chart, but tax really does matter. And it's the one thing, where if you are conscious of it, you can make sure you're getting the right outcomes. An obvious one is when you're trading an ETF, or look, any other stock for that matter, through a broker, you'll receive, once you hit the registry, you'll receive a form requiring you, or requesting that you submit your tax file number. I would always recommend doing so, because that means that basically tax isn't withheld from distributions that you receive. But also sort of record keeping. With any form of investment, that there's a lot of admin involved, but calculating your capital gains, calculating tax outcomes is really important. It is also sometimes a little bit sort of tricky to understand whether or not the performance of your investment has in fact been net positive or not, because often in a brokerage account, what we see is the buy price and the sell price, and they don't include the amount of distributions that you've received along that investment journey.
Yeah.
Buy price and current close price. And if my current close price is below my buy price, that looks like I've lost money. Whereas, you will find, for example, a lot of fixed income ETFs pay out pretty significant distributions along the way. So having good records, keeping a spreadsheet of your investments outside of your trading platform that incorporates all of those aspects can be really valuable for really understanding what's going on in your portfolio.
Mate, I love this chat. We said it was going to be just like 30 minutes or so, but we've ended up talking for nearly 50. One of the things that I discovered as part of putting this together tonight is that the Betashares team have put together a Learn the Basics of Investing. It's just a free kind of self-paced course that you can take online. It's got videos, covers all the major topics. It's really great UI. And if you want to get involved, there is a link in the video description. So just in the YouTube description here, you will find a link to this course. It's all free. It's all available on the Betashares website. So it's a great resource. And just having you come along tonight, mate, is wonderful. So I really do appreciate you taking some time. I hope to one day we'll be able to do one of these in person. Even though I'm in Sydney, you're in Sydney tonight. The stars didn't align when we were in the same room, but I really appreciate you taking some time to join us tonight.
Of course. Great to be here. Thanks a lot, Owen.
Thanks, Cameron. Really appreciate it. So that was Cameron Gleeson from Betashares ETFs. I had hoped to get some questions, but I also did set expectations with Cameron that it might only be 30 to 40 minutes, and we just kept talking, which is great because it's just, as you can see and you can hear just now, that it's wonderful to be able to chat to someone who has so much experience, and he's on the other side of the curtain, like he's inside the factory where the sausage is made, who can tell us how it's all done. So that was a real treat for us. But I can see some questions have come through, so I will try and tackle some of them here. I haven't actually looked through the most recent ones, but I did see a question, and it did come through from Jeremy. Jeremy, welcome back. It's been 11 weeks since you've come in and had a chat with us, which it's great to have you back with us, mate. And also, I have seen a few comments about my facial hair. You see, what the thing is, when I'm on the road, I don't like to take my electric shaver with me. So what I do is I just shave it lower the days before I leave, so I don't have to worry about it. And this is coming from a guy that takes very little care, self-care, in terms of dressing myself up for the important meetings. I love it because everyone around me is very well dressed, but I don't have to put in any of the effort. Everyone can just admire my t-shirt. In any case, thank you for the comments. Okay, so Paul, you've said, if holding for the long term, 10 plus years, does a few cents or dollars when buying make that big of a difference over the longer term? Now, I might actually try and find something on the fly to answer this question. There is actually a dollar cost averaging calculator that is available online. I think it's called investment. I'm just going to try and find this. I think it's like investment frequency. Okay, so it's this one right here, guys, and I'll put this link in the chat. It'll come through as the host. So if you just check this out, I didn't make this. So I can see so much praise for Cameron, by the way, which is really lovely. So it's really good. You can find out more about, obviously, Betashares and Cameron online on the Betashares website. So go and check that. So if you look here, this calculator, it's obviously like made by a developer or something like this. I didn't make it, so no risk on my behalf. But basically what it shows you, right, is it allows you to make a decision. So if you want to, say I get paid monthly, and say my savings are, I don't know, $500, and my interest rate on savings is $4%, but my respected returns from my portfolio say 7.5%, and my brokerage is $9.50, which, hey, it's already said it that. The calculator did this for us. It basically says to invest $2,010 once every 4 months, as opposed to investing every month $500. So it's a really powerful calculator. I can see Owen. So someone beat me. Rob beat me. So Paul, Rob beat you. So this is the thing that I would be using to try and help me make a decision of, like, how much do I have to invest? When should I invest? And obviously, if we bring down the brokerage, let's say brokerage was $1, I'm pretty sure it would say just invest it every month. But the reality is that we can't do that every month because there are fees from the ASX and so on that doesn't allow brokerage providers to go that low sustainably. So that's one of the things. So keep your questions coming through, guys, because I'm here for a little while. But one thing that I might just quickly recap on is when we started this journey of this all-weather portfolio series, we started with 4. You might remember there was originally 4 parts to this mini-series. I've expanded it to 5, and I'm contemplating expanding it to 6 if you want me to, because I thought what we might be able to do is each one of these have a different expert. So we've obviously seen Cameron from Betashares. Each of them have a different expert coming on the program. So we're going to get different views from every major ETF provider, I hope. But I'm contemplating expanding it to a 6th one because then we could potentially make it a final session where we actually build a core portfolio together and we bring it all together in a final session. So if you want that, please let us know. Please let us know. And that would be, I think it'd be a bit of fun anyway. So I can see some questions coming through here. So Harry, you've asked a question about the CRIP ETF from Betashares, which was one that performed very poorly. It's fair to say. And I did actually ask Cameron about that. I didn't see a question come through till now. I did actually ask Cameron about that on the Australian Investors podcast, which Selfwealth is a sponsor of. But if you go and check out the Australian Investors podcast, like if you Google this, Cameron Gleeson, we talk about the CRIP ETF and where it kind of fits and whatever, and mistakes or whatever. It's a really good conversation, and Cameron answers that really thoughtfully. So didn't shy away from it, which is fantastic. Okay, so I can see a few questions. This is such a helpful list and a great presentation. It's good to know I'm on the right track. This is Caroline. It's cool to see how much I've learned since my first trade last year. Well, fantastic. That's wonderful. We did actually, and there's a question here from a comment here from Owen that says record keeping equals, hey, accountant it. Here it all is. This is what I paid you for. The problem if you do that, Owen, if you take all of your ETF statements and you just send them across to the ETF provider, there are a few things that might be missed. One is you might not have registered your tax file number with the share registry, and so you may be paying excess tax, and your accountant may not know that because they may not have it sitting in your MyGov account when they try and do your tax return. The second thing is that if you just rely on your accountant to do it all for you, you're probably not going to pay close enough attention to how much tax is being paid, when things are being paid. And finally, you'll probably end up paying your accountant more. So if you can consolidate that for them, maybe there's a way that you can kind of do it all, and it can be a bit more efficient, because rather than paying an accountant $250 an hour, maybe there's an easier way. But you're right, like if you just take that annual statement that you get from every ETF provider, you can just hand that to your accountant, and that's probably the easiest way to do it. There are other things like Rob and I have talked about on the show before, ShareSite, which is some software that you can get, and correct me if I'm wrong, guys. It's free for up to 10 holdings, and it tracks your portfolio. I think, Owen, you might know about another one, which is it Navexa or something like that? Or maybe Paul, someone's mentioned this in the past. Can we ask questions now? Yeah, send your questions in, Francis, please. Please send them in. Apologies that Cameron had to run off. I did promise him it would be a shorter session. Francis, you've said, should our investment strategy be dollar cost averaging or buying and selling high? So, Francis, I truly believe that an investment strategy should be dollar cost averaging for ETFs because market timing statistically doesn't work. So I'll bring this up. I'll show you what I'm looking at on my screen. Does market timing work? And there was a study done by Schwab, this one right here. So I'll just drop this in the chat now. Francis, I'm just going back to your question from a little while ago. So just for everyone that's playing along. So what Schwab did, Schwab's a big brand out of the US, you will know, big bank and investment house. So they basically tracked 5 investors through time: Peter Perfect, who had perfect timing; Ashley Action, who just bought some ETFs or bought the market; Matthew Monthly, who divided his $2,000 up into monthly; Rosie Rotten, who had the worst possible timing; and Larry Linger, who just left his money in cash. And basically what happens here, guys, just to confirm what's happening, is they did a test where they gave these 5 fictitious people $2,000 at the start of every year. And there were 5 different scenarios. Obviously, we've got the guy with the perfect timing, the lady with the worst possible timing, the person who put it in monthly, the person who put it in straight away, and the person that never invested and just kept their money in cash. And these are the results. You can see here that the results from 2001 to 2020, if you have perfect timing, you're obviously going to do the best because you know, and you've got a crystal ball, and you know for sure. You also have a time machine. The second one is if you just invested on January 1st every year. The other one is if you broke it up monthly and you just put the money in every month. This one is the worst possible timing. And this one is if you just stayed in cash and you never invested it in the market. Obviously, there are some conclusions we can draw from this, Francis. The last one is that if you just stayed in cash during that period, terrible decision, absolutely terrible. Maybe you were too scared to invest, terrible decision. If you were perfect timing, great, but no one has perfect timing. So we can all just forget that. No one does. I'm confident to say that I've been doing this long enough. I've never met someone that has perfect timing. A broken clock can be right twice a day. And some investors, famous investors, maybe those that appear on big Hollywood movies, those investors were right at least once. But were they right twice? Were they right 365 times a year? No. Eventually they get it wrong because they try and time it. So I'm all about not doing that. And I'm all about doing this in the middle here. You just get the money, invest it, or dollar cost averaging. And the reason I have confidence in this is as follows. The difference between the best timing you could ever have and just doing it, like just automating it, is not that much. It's only this bit in here, right? But the difference between not doing anything and just doing something is very wide, meaning that the risk that you never invest because you're trying to time the market is so much greater than the benefit of just going, I don't know what, I can't predict this thing, but I'm just going to put my money in anyway. That is a trade-off that I personally am not willing to take. So that is what I would say. That is what I would say. So yeah, please get your questions through. So I've got some questions here, and I'll be quite quick here. So Artian said, questions. I love questions. I can see a question. So should we continue putting new money into the share market or put the money towards a mortgage, which might be 5 to 6% plus? Artian, that's a great question. I can see some responses here. It's obviously dependent on personal circumstances. Morgan Housel, who has a great book, The Psychology of Money. I know some of you have read it. I think it's fantastic. He has in his book this really interesting line, and he did an interview with Tim Ferriss, which was absolutely brilliant. I'm going to bring this up now. I'm just going to dump resources in front of you, but the resources that I'm trying to show you are evergreen resources that even someone watching this in 2 years from now can listen to. So this podcast is the only podcast that I've ever listened to that it goes for more than 3 hours. I've listened to more than 3 times. So I've put 9 years of my life into this just this one podcast episode. Well, this one here says it's 1 hour and 52. I'm pretty sure this episode here, this is the episode here. I think it's 3 hours. Yeah. So it's 9 hours of my life. And in that book and in the interview, one of the things that he says is that the behavioral choices that we make with money rarely are the best looking in a spreadsheet. So and this is just my paraphrase, by the way. And so what he's suggesting is that what makes you feel good isn't always the thing that gets you the best results. So maybe in theory, a decision could be pay off mortgage or invest. And maybe investing in 20 years from now will be the better choice. But maybe mortgage will make you feel better and minimize the chances of you making a behavioral mistake. Maybe paying off a mortgage were better and investing was not the better choice. But you have to, at any one time, find the balance between what's good and what's good financially and what's good for you emotionally or behaviorally. Now, for a lot of people, it's going to be that they pay off their mortgage, and that's fair enough. A lot of people want to do that for 100 different reasons, but one of them might be lifestyle design. They want a better life. They want to be debt-free because that liberates them in other ways. I have a friend, for example, who's an investor, and he just puts he's a really good investor, but he just puts everything he can into his mortgage. And he said, Owen, the reason I do this is because maybe I pay off my mortgage in 10 years. And at that point, I can choose whether or not I want to get a loan and then invest that money. But he goes, until that point, I don't have that choice. So I'm going to pay it off. And he's a really good investor, and he's made that choice. So, okay. So, questions. Yeah, I can see, I think it was Paul, you joked about me doing 25 2 hours. Oh, no, it was Jason, 25 2-hour sessions. Lock it in, Eddie. I don't mind that. Well, I've got to be here anyway. So Rob and I have got to do the live shows. So why not? No, I'm kidding. But maybe, we do want to do a value investing mini series as well, which will be coming up after the ETF series. So that's kind of like our hard bumper where we can't go past a certain point, because we want to get these Australian experts, and believe me, they are brilliant. We want to get those guys on the show to do that. So that will be a little while. When you said I couldn't be stuffed with DCA, just chuck it in. Okay, in around 1 hour. So Francis, you've asked another question. You've said, with a macro picture in mind of the current geopolitical tensions, is it still beneficial to invest in ETF rather than commodities like gold? Well, this is the eternal question, Francis. And what I will say is I'll take that question on notice, because let's just say one of the guests that will be on the ETF mini-series in coming weeks here on Selfwealth Live is from the ETF provider that offers the biggest gold ETF in the country. And it was the first, if I'm not mistaken, it was the first gold ETF. Maybe it was the first gold ETF in the world. So they'll be coming up. So we'll put it to the experts. Rob's just said, personally, I'm appalled by 54% no answers. So he's got, this is in the poll. If you are tuning in, you can vote on any polls that Rob puts up in the chat. I actually can't see the poll right now, so I'm just gonna jump into the live and see what's there. And see what's there. Please keep your questions coming in. We'll go for another 5 or so minutes, and then I will dart off and find myself some dinner. Should Owen bring back the beard? Now, this is what I was waiting for, and I did not expect this, Rob. That this is the poll, and 51% are saying no. It's just swung to yes. Owen should bring back the beard, which is quite controversial, Rob, because Rob, I know he's not behind the camera, but Rob also does like to sport a bit of a manly beard. So this could go both ways, Rob. Both of us may have to invest in shavers, which could be a bit of a problem. Anyway, back to your questions. Okay. Owen, you've said, I played with ShareSite and Navexa. This is the portfolio tracking software, and I can see here it says you prefer Navexa, which is very interesting. So thank you. Okay. Raptor, you've said, if a savings account interest theoretically goes above 7%, like in the 80s, which is comparable to the ASX average of 7%, wouldn't it be better to put it in cash? Yes, Raptor. So just to come back to the big spiel that I went on before, when we compare the returns from a mortgage, like paying off a mortgage versus investing, there are the key insight, which is most people understand this, but some people still catch up to this, which is fine, is that let's say that both the mortgage and the shares have a 7% return. So meaning that if your mortgage interest rate was 7% and the shares were offering, like if we knew for certain that the shares would return 7%, if we knew for certain, now what we would do is we should pay off the mortgage every day of the week. Why? Because we pay tax on the shares and the profit that we make, but we do not pay tax on saving interest on our mortgage. So if we pay off the mortgage, the tax office isn't going to come after us and say, hey, you paid off your mortgage, quick, pay us more money. But if we make a profit on our shares, then we pay tax. So typically what we do as an industry is we take this return down 30%. So in this case, it would fall to around 5%, in which case the theoretical return from mortgages is higher than it is from, say, an ETF portfolio. So in that instance, it makes sense to pay off the mortgage because you save more than you make after tax. However, something does happen here which doesn't make this trade-off always easy, Raptor. The first thing is interest rates don't always stay high. And typically when interest rates are high is typically when the long-term upside from investing is better. So what I mean by that is as interest rates go up, shares typically get pummeled, right? They typically fall. That's what we saw last year. But what that means looking ahead is that if interest rates fall again to, say, like a historical average, the return from shares should also go up, right, in the future. So the benefit of investing when the return looks bad is actually tends to be the time that you want to invest. Now you can see how this gets quite complicated. So it comes back to that old mantra of, well, what makes you feel good? Because does dollar cost averaging make you feel good? And do you just want to automate, or do you not? And finally, what I'd say is the questions that I'm getting, we get dozens, if not more than that, questions every week coming through Rask. And the questions that I'm getting now have shifted more to this side, the mortgage side, pardon me, than the investing side. And what I say to people is, it doesn't have to be 100% this one and 0% that one. You can just say, well, I'm going to keep paying off my mortgage because it's stressing me out and I think it's a good return. However, I also don't want to break the habit of dollar cost averaging. So I'm just going to put in the minimum amount or a regular amount that makes this itch scratched and this itch scratched. So both feel good. And I'd say that's what people should do at any one time. And also, another thing to keep in mind is that you don't have to pay off your mortgage. Now, this is me coming from a finance background. You don't have to pay off the mortgage. One thing you can do is you can use an offset account where you put money in the offset account and it has the same effect of paying off a mortgage, but you can pull it back in the future if you want it. So, for example, with my bank, we have 99 offset accounts. I've said this before. We have 99 offset accounts attached to our mortgage. So basically, no matter where we put our cash, our emergency fund, all that, it's always in an offset account. We don't technically earn any interest from our bank accounts, but we have offset accounts that effectively mean that we save more in interest. Okay, Chef Circle. Okay, a couple more questions. Jeremy said, my question on DRPs above. DRPs. Okay. Say I have set up a DRP, but dividends didn't return enough for a full share. Then I cancel the DRP. What happened to that money held by your share registry? Okay, so in this instance, let's go and use an example. Let's take the NDQ ETF from Betashares since we're talking about it. So this ETF was last traded at $30.11, right? So that's the price of the ETF. Now, if we go down to distributions, right, this bit right here, we can see that the last distribution that they made was in January, and it was for 3 cents. The one before that was 84 cents. The one before that was $1.17. So even if we added all of these things up, which is over a few years, we still wouldn't reach the amount of $30.11. So people would be asking, well, if I've got a DRP set up, and hypothetically, let's say you only own one of these, you only own one NDQ. So your total investment is worth $30.11, and your most recent dividend or distribution, if I can go back to where I just had it, is 3 cents. And you've said in your share registry, so in Link Market Services, which is the one for this, you've selected in there that you want your dividends or distributions reinvested back into a share. Obviously, you would need a lot of these before you'll finally get one of these given to you in your account. So what happens to the money that you're saying should be reinvested but can't be right now? So it's a really good question, Jeremy. It's a really good question. Now, what happens is the money sits with the share registry, and they hold on to your sweet, sweet cash until you do something with it. If you've ever wondered why some money goes into that lost money thing by the government, and they're always urging people to go out there and find the lost money, this is one of those examples of where money can be lost. And that's technically your money. So you can elect to get that back, as far as I know, and you can say, pay it back to me. And that's just by logging into your share registry and making sure whenever you buy an ETF or whenever you buy a share and you get that piece of paper that you've logged into your share registry and you've set up your tax file number. Because then even if you sell that investment, it's still against your tax file number. It's registered there for you. Yeah. So that's 99. Which bank is that, says Paul? That's Bank of Melbourne, mate. You should always see a financial advisor for any of the things, particularly with mortgages. See a mortgage broker, a really good mortgage broker. Please go and see one, because a really good mortgage broker, a really good accountant, and a really good financial advisor, they seem expensive. Well, not so much with a mortgage broker because it's paid out of the commissions from the bank. But the others, the cost of good advice is free, as they say, even if it costs a lot of cash, because it pays for itself. And just to summarize that point from before, Jeremy, if I had a small investment amount and I selected a DRP, I probably wouldn't do that. You would know, Jeremy, because you probably listened to the podcast with Drew. Drew doesn't like them for that very reason, because if you have a dividend reinvestment plan automatically set up, what's happening is you're committing to buying that ETF every time you get a distribution, no matter what. Why not just get the cash and just do it when you're ready? You can automate it outside of that too. You can just have the money sitting in your bank account and whatever. Okay, so I'll get to a couple more questions. Chef Circle said, hedged or unhedged ETF? Chef Circle, that's a cracking question. It's a bit more advanced than most people would be prepared for. I'm just going to try and find this thing. I created a chart on one of our websites. I'm going to try and find for you. And if I can't find it, I'll take it on notice for another time. Oh, I hope this is the one. What is this? Okay. All right, I think I found it. All right, I can share my screen with you guys. Okay, so this is one of the websites that I created. And this website, what it actually shows you, I'll see if I can zoom in a bit. So what this website actually shows you, and it looks very convoluted, and you know that I don't like charting, so keep that in mind. It's just not what I do for me. Now, what this chart actually shows you, it shows you the Australian dollar over the long term, so since 1993. What these green lines above and below show you, it's what we call Bollinger Bands. It sounds weird, and it's not like an old Australian cricketer, and it's not your favorite Friday night band at the local pub. What it actually is it's just the standard deviations. You might remember that from statistics class, where it's just showing you what is the range in which the Australian dollar most likely trades. So you can see at certain times, the Australian dollar gets up towards the top of the standard deviation, and other times, like here, it goes lower. Now, some people use these for trading signals. I do not. But however, what I do look at is the statistical average over time. So this orange line is showing you the long-term trend in the Australian dollar, and the other line shows you where it might be moving up or down. And now what we can see here, see at these certain points, like in 2020, it's very small on your page, so you might have to zoom in like me and get right up and close. And you can see here is it moves towards the bottom of the statistical average, right? Now, this is pseudoscience. This is like, it's not quite, getting a healer to run their hands over your head, but we're talking about like just the rules of thumb of the finance industry. So what we can see here is that when the dollar gets down towards this line, it tends to come back. And now, I don't want to bore you too much with the details here, but ultimately, Caroline, you said I'd add a good lawyer to my list of experts. Absolutely a good lawyer, particularly if you're in business. Get a good lawyer. Obviously it's fantastic. Costs a lot, but they're good. So basically what we do, Chef Circle, and this is what I do, not claiming that it's bulletproof, but what I do is we use that chart to influence when we should start using some hedged ETFs or when we should start using unhedged ETFs. So everyone, just so you know, what a hedged ETF does is it cancels out the impact of currency. So in the case of the one that we saw before, NDQ, from Betashares, this is the NASDAQ 100. Pardon me. They also have a HNDQ, which is this one right here. This is the same ETF, except it neutralizes the currency. So you get the same companies in the same proportions, but what you also get is that they cancel out the Australian dollar movement. So when you think the Australian dollar, like right now, if you think the Australian dollar is low, you might be thinking, well, maybe I should hedge and maybe I should go back and let the currency run back up and then I'll invest more money or something like this. So the changing, as Jason just said, when you change between hedged or unhedged, it actually means that you're buying and selling. So what we do, Jason, we don't ever typically sell out of a position because of currency. At Rask, typically what we do is we typically just tweak the portfolio balances. So at most, we might go to like a 5 or a 10% hedged version versus an unhedged version. Some people, as a rule of thumb, they actually just go, we'll just go 50-50, which I think that's more of like a regret minimization framework. I don't know the answer, so I'll just cut it in half. Maybe. But what statistically tends to be the case, if you're a very long-term investor, not always, but if you're a very long-term investor, and all of the things that I talk about, by the way, are very long-term, is what tends to be the case is that the impact of hedging or not hedging reduces. So meaning that over time, your decision to hedge or unhedged, if you're dollar cost averaging, like you're just investing little bits every month, tends to neutralize. Now, of course, if you and I were just like, hey, taking a bet on where the currency is going to be at the end of the year, and we both had $500 and you had to do all or nothing, well, one of us is going to be right and one of us is going to be wrong. However, if you're a long-term investor where you do dollar cost average, the returns should eventually smooth out, and you don't, the impacts of it don't make such a big deal. Okay, got to bail, Owen. Good point. We thank you for coming along. We might have to bail in just a second too. Okay, so own both hedged and unhedged. Then, Paul, we have a little bit of hedged in our core portfolio at Rask, but most of it's unhedged. So I hope that makes sense. When I'm investing in individual stocks, however, like so not in ETFs, but individual stocks, I do look at currency impacts. So I look at currency impacts. Like if I'm investing in the US, I'm not going to get much bang for my buck right now. So I do make that conscious choice of, do I just keep the money in Australia? Because my investments in individual shares aren't typically for 10 years, although I like them to be. They're typically like 5 to 10 years. I'm typically a bit more sensitive to the currency. But if I'm investing in if I'm just dollar cost averaging, I just kind of just don't think about it too much. Okay. Any other questions? Oh, Francis, last question maybe from you. This is a good one. You said, with the collapse of US banks and volatile stock price, should we use this opportunity to buy the ETFs at a discount or maximize earnings with bonds and high yield savings? So Francis, that will come back to your personal circumstances and what everyone should do independently. As I said, what the finance in the 1970s, I think it was the 1970s, the finance industry went from economics, I went into the Department of Economics and away from the Department of Psychology, which is quite interesting. Most of the decisions that we make with our money are behaviorally driven. No one really sits down and plots a chart and there's a table and figures everything out. Most of us should actually just do what feels good for us, but also being aware of what tends to happen over time. So making a conscious choice whether or not to invest. If you understand that the stock market and any type of investing tends to be the best thing to do with your money, well then you've made an informed decision if you don't invest. You're like, I'll take the risk that I'm not going to grow wealthy. Fine. But at least I'll feel good about it. Fine. That's okay. But if someone takes the opinion that, you know what, I do care and I do want to grow wealthy and I'm willing to take the risk, then I should be investing. And so, Francis, I think, if I'm not mistaken, I think you've asked two questions, the same question, but in the opposite way, meaning that if you're worried about the geopolitical risks and the market, should you avoid investing? But because markets are volatile and maybe there's uncertainty, should I be investing more? I think the answer on balance is exactly the same, is that most of us would just be fine. Like, I'm not saying it's right for you, but just in general, most of us, according to the literature, seems to suggest that we should just invest. Jeremy said, re the beard, hedged or unhedged? The answer is both have their value. Exactly. Beard unhedged. Indeed. Okay, so I've got to let Rob go behind the scenes. I've got to jump off, might organize some dinner for myself. And I hope all of you got something from tonight with Cameron, indeed. We'll be back next week. Let's just say the guest from next week, it's not someone that I've ever interviewed, and I'm quite excited about that. And let's just say, wink, that this person may be from one of the biggest ETF providers in the world. Wink, you might be able to guess who it is. And we're delighted to have them on the show. So we've got a few weeks of really good guests on this ETF mini-series. And it's only possible thanks to Rob and the team at Selfwealth who make this show happen and help me organize some content. So really huge props to Rob and the team at Selfwealth. Obviously, you can find out more about myself by heading to the Rask websites. But also, if you like the series, you could always consider sharing it with a friend or suggesting that a friend, if they haven't looked at ETFs, maybe they could learn something by coming along and taking part in these sessions. So obviously, we're going to talk about rebalancing, how to actually build up an ETF portfolio. We're going to answer some questions and talk about thematic ETFs. Now, this last one is going to be the really interesting one. This is actually from, I believe, I think the guest that will be coming for this, if I'm not mistaken, is the biggest ETF provider in the world. So I think this one is from the second biggest ETF provider in the world, and I think this one's the biggest. So, Rob, that's a great comment there. Thank you for putting that in the comments, Rob. I do really appreciate that. Finally, here's a bit of sage wisdom to see us off into the evening. Progress lies not in enhancing what is, but in advancing towards what will be. Khalil Gibran. So, a fantastic quote. Progress lies not in enhancing what already is, but in advancing towards what will be. Maybe that's a quote for the last ETF session we'll do, where we talk about the past, present, and future of ETFs. It's quite interesting. Thank you for joining us. Once again, we'll see you next week. Same time, I'll be in a different location. Who knows where I'll be? I don't know if you'll be in the same location, but I'll see you then. I'll see you here. Self-Love Live every Wednesday night, 6 p.m. Catch you then. Have a good night. Stay safe.